mean, we're expecting 225 basis point rate cuts this year, both in the second half after there's been some improvement on inflation. Our guess is that the labor market is fine, but still weak enough that it keeps rate cuts in play, and the Fed doesn't signal an all clear despite the good top line growth. It's a challenging environment for the Fed and for monetary policy.
Thank you so much, Jonathan, for being here with us today. Welcome.
Thank you very much for having me.
So I just want to start with the Fed. So we see the market is still kind of remain divided of the pace and the size of the Fed rate cuts, right? So what is your take on that?
Well, I mean, there's a lot of uncertainty right now in the U.S. economic outlook. I mean, investors and most economists, they're pretty optimistic about U.S. growth in 2026, but inflation is still close to 3%. How the Fed is going to weigh some concerns over the labor market, but seeing probably good top line growth against, still roughly 3% inflation, it was a little bit of a challenge for them. And there's the added uncertainty of we're likely to have a new Fed chair after Jay Powell ends his term in May. So, I mean, we're expecting 225 basis point rate cuts this year, both in the second half after there's been some improvement on inflation. Our guess is that the labor market is fine, but still weak enough that it keeps rate cuts in play, and the Fed doesn't signal an all clear despite the good top line growth. But it is a challenging environment for the Fed and for monetary policy when they will have a lot of conflicting signals this year on inflation and the growth and labor market outlook.
So among all the reasons you just mentioned, what will be the main driver for Fed to make their moves?
So I think the biggest driver of the Fed this year really is going to be the labor market. We saw last year the Fed really shift in their concern from inflation above target towards protecting the downside risk to the labor market with their 25 basis point rate cuts in the last 3 meetings. I don't think they're going to do the same amount this year, but I do think we're probably going to have slightly elevated unemployment. I think that will be a concern. I also think that will be a particular concern for whoever President Trump picks as the next Fed chair. I think they will weight the labor market quite heavily, I think, in their determinations of policy.
I want to talk about the Fed leadership a little bit later, but first, what's your expectations for the U.S. labor market heading into 2026?
Our expectations for the labor market, they kind of follow our expectations for the overall economy. I think in the first quarter, the labor market's probably going to continue to weaken. I think the unemployment rate probably is going to move up a little bit from the December level of 4.4%. But I think after we get to the second quarter, say May or June, that will probably peak and then things will improve after that. Now, I don't think they're going to improve really rapidly or have some sort of big acceleration in the labor market. I do think that artificial intelligence and the investment is starting to increase productivity gains, so firms won't need to hire as much as they might otherwise. But I do think that you will start to see some acceleration in the labor market starting in the middle of the year. But I think overall, you're still going to have a slightly elevated unemployment rate, roughly 4.5%, I think, at the year end. So I do think that's sort of weak enough that you still do get the 2 rate cuts this year.
So on the inflation side, do you think the disinflation process will be pretty much complete in 2026, or we will have more stickier inflation?
Well, I think it's going to look sticky, but what we really think is that the tariff pass-through to prices is really sort of delaying the headline disinflation somewhat. So we're expecting roughly 3% inflation in the U.S. We think it would probably be close to 2 at the end of this year if it weren't for the tariffs, in fact. So, we are a little bit worried about inflation remaining sticky. We do see some positive news. Nominal wage growth has cooled. We're seeing deceleration in rent price growth. So those things should help inflation over the course of the year. But we do see some tariff pass-through coming through. It's going to keep inflation elevated in the first half, keep the year-over-year rates elevated probably through December. But we do think we will get more disinflation. We're just going to have to wait until 2027.
And just as you mentioned a little bit earlier, besides inflation and the labor market, we also have the big uncertainties around the Fed leadership. So how do you think this will impact the Fed policy and probably the market expectations for the policy as well?
Well, I think right now, I think the market expectations are that whoever that new Fed chair is, if not cut rates right away, that they are going to try to push rates lower over time. So I think that is a general expectation. When I think about the Fed chair candidates, though, it's a lot of uncertainty. I mean, they could have very different ways of setting policy. They could have very different communication styles to the market. So, how the market reacts is really uncertain. Plus, one Fed chair might be more effective than another, right? I mean, I remember being on the board staff under both Chairman Greenspan and Bernanke. They had two very different styles. Now, one was a practitioner, one was an academic, and they had different ways of leading. So we'll have to look at the next Fed chair. They will bring their own tools. How do they use the staff? How well do they get along there with their colleagues? Can they convince them to follow them on policy decisions? Each one of the candidates is quite different. So I do think it's a big source of uncertainty. But I also think that, I don't think the market really realizes it yet. The market's really going to have to figure out like a whole new monetary policy reaction function. And I don't think people are really thinking about that yet.
Yeah. So I want to step back from the policy and turn to broader economy. So I actually looked up a lot of outlooks and forecasts, and there is consensus seems to see US GDP growth will be around 2% this year. So what is your baseline scenario for US economy this year?
Well, it's not going to sound much different because I'm expecting roughly 2% GDP growth this year. I think there's more uncertainty about that, but I think one thing that is behind all of our forecasts is that we're all waiting to see the impact of President Trump's One Big Beautiful Bill Act. So, all of us, we think we know what the tax cuts are going to do and that there's going to be extra tax refunds. We'll learn a lot about that in, say, March or April. And I think at that point, you'll start to see more divergence. People start to revise their forecasts because by then we'll sort of know, how much sort of money are being put in people's pockets from that tax bill. But I think, right now, not many people are talking about recession in the US. Most people are modestly optimistic about growth. So we'll have to see how that unfolds. But I'm not particularly out of consensus at the moment.
So will there be risk behind those fiscal policies? And do you see soft landing is most likely, as you just...
Well, I think there is a lot of risk, around the fiscal policies because we all in our forecasts are expecting it. And that fiscal policy also, should help broaden growth, a little wider. I mean, I'm sure you've heard of the K-shaped economy. That fiscal policy should help a little bit address the K-shaped economy. And I think that's also important for financial markets because financial markets are expecting more than just the tech stocks to rise in 2026. So if we're really going to see this kind of broadening in the economy, broadening and strength in equity markets in the US, how that tax cut unfolds is really, really important. But, if this is going to unfold this way, we would expect a soft landing.
So speaking of the financial market, we see US equity actually held up relatively good, given all those macro uncertainties last year. So do you think it will be the same case this year?
So not in the same way. I mean, last year, the AI and tech-related stocks really drove a lot of the equity market outperformance, whereas a lot of other sectors, didn't perform quite as well. And I think you saw that in the real economy last year as well, where the AI tech investment in the U.S. economy drove an unusually large share of the growth, plus the AI stocks moving higher made upper income households more wealthy, driving a lot of the spending growth. So last year, the growth in the US economy was really quite concentrated, and so were the equity market performance. I'm not sure how much that can persist. This year, we're expecting strong equity market performance, but we're also expecting it this year because the economy is going to do better and more sectors of the economy are going to do better. So I think it could prove challenging for equity markets if the real economy doesn't do as well this year.
So do you worry about the market will probably be overly reliant on the AI narratives?
So I think that's a huge risk, in part because, the real economy is heavily dependent on, AI investment stocks. So, I do think that is a big risk to the economic outlook. Obviously, it's a big risk to markets. If those stocks disappoint, they're a big share of every average. They're going to pull down, the wealth of a lot of households. So that's a big risk. Now, we at UBS, we do not think this is a bubble. We look at cross-market correlations. This looks much more like, say, 1998 than it does like 2000. So, we don't think we're there yet. So we're relatively optimistic about the equity market this year, selective on some of the tech stocks. But we do have a year-end target for the S&P 500 at 7,500 in the investment bank.
Mm-hmm. So besides the tech stocks, what other sectors probably also have like good opportunities?
Well, our equity strategists talked about, trying to get, maybe consumer cyclicals participate, as well as some of the other sectors that would, benefit from broadening and growth. We could next year, from an economic standpoint, we are expecting better housing market activity, home building, more middle income consumers consuming, hopefully manufacturing stops contracting. So there are, I think, going to be, sort of a wider set of potential positives in 2026.
Mm-hmm. So do you think the US dollar will remain relatively weak in 2026?
So, there was a certain amount of weakening in 2025, and that may still have a little bit more room to run. But further out in the year, we're generally thinking the dollar has some room to strengthen here. If equity markets in the US are going to run up to 7,500, that's a solid returns. If we are going to maintain this brisk pace of AI-related CapEx, and we're going to see it grow, and if we start to see all the productivity gains that could come from that, we think we will see elements of all of these things. Most of that is dollar positive.
Mm-hmm. Also, last but not least, just for global investors, what will be probably the most overlooked risks and also most compelling opportunities in 2026, if you have to name?
Well, we've got a sort of a wide range of different trades opportunities that we could talk about. But at a headline level, we are relatively bullish equities this year, U.S. Over Europe. Some other favorable calls as well. I think there's sort of three sort of risks overlooked thing. I think investors should realize just how reliant all of the outlooks are on tax refund season and the benefits and impacts of the tax cuts. Now, this is something that we'll get data on almost every day in the U.S. So I would encourage investors, over the sort of next 4 months to watch that data quite closely, because if we're not seeing the benefits, for household balance sheets in March or April, that's going to signal that something's wrong. And on the other hand, if household balance sheets are really benefiting from all of this extra cash in March and April, well, we could be off to the races for a great year for the U.S. economy.
Mm-hmm. Thank you so much. That's all the questions we have today. And thank you for your time here.
Thank you for having me. Thank you.
Thank you.